The Fed just cut rates. Mother. The Fed just cut rates. The Fed, short for Federal Reserve, just cut interest rates for the first time since 2008. So the Fed really has a couple goals that they want to use to try to shore up the economy and keep things strong. They want to keep unemployment low, and they want to make sure the economy keeps growing without inflation getting totally out of control. So what is the Fed rate that we always hear about, and why does it matter for you or for me? The Fed rate actually represents what is called the federal funds rate. The federal funds rate is the interest rate that banks charge each other for lending each other money on an overnight basis. So the Fed rate dictates how cheap banks are getting money from one another. So what this means is the cheaper the banks are getting and moving money, the cheaper that banks are going to be able to extend loans and products to customers, and the more those customers are going to be able to invest and use loan products to buy, and that is what grows the economy. Up to a point. That point is the inflation rate. High inflation is basically swine flu for the economy. With reduced buying power of money, increased prices across the board, there's less purchasing, less investing, with only a few bright spots, one of them being your savings account will yield a slightly bigger return, if you have any money left. That's assuming you have any money left after you spend $12 on a coffee and you're spending $2,000 a month on your premium Snapchat subscriptions. So why did the Fed cut rates? 3 reasons. Number 1. The economy just isn't as strong as we thought it was. Yeah, unemployment is super low, a 50-year low actually, but the economy just isn't growing as fast as it should be. And from what we know now, the Fed actually admitted that they fudged up back in December when they decided to raise the rate. They're describing the rate cut not as a warning sign of bad things to come, they're trying to protect the economy from impending doom, but they're calling it an insurance policy to protect the economy. Number 2, inflation is low, too low. Is that even possible? Yes. Low inflation usually comes from either 2 things, either high unemployment, we know that's not the case, or decreased consumer confidence. What does that mean? Consumer confidence is the likelihood that people are going to go and invest in new things, businesses are going to invest, businesses are going to try to grow, or people are going to go and they're going to be taking out mortgages, auto loans, personal loans. The money is going to be moving because everyone is confident that the economy is in good, sound health, and that they aren't going to get caught with their pants down like we all did in 2008. Well, like you all did in 2008. I was like 14 years old. Basically, low inflation is a sign that people aren't willing to spend. So the Fed's solution to low inflation and poor consumer confidence is to decrease the federal rate. Number 3, politics. With this new trade war starting in 2020 being an election year, there are a lot of people out here that are nervous about a lot of different things. And you can see this every day in the stock market since this trade war began. There are massive swings up and down. Right now, people aren't sure what's going to happen or how to act, and that's causing a whole lot of volatility throughout the market, and that is going to trickle down through the economy, even aside from the physical effects of this trade war with China. Just the emotional response is going to drive the market in a way that's not really safe over a long period of time, but eventually I'm sure it will calm down, but right now we are all over the place in the markets, and this is something that the Fed is really considering and is coming straight from the White House at this point, to where the Fed lowered rates and the president is actually saying that we need to go and cut the rates more right now, and we actually have different politicians and officials coming out saying, you know what, no, we're not waiting till September. You need to hold a meeting right now and announce that we are cutting rates even more right now, an emergency meeting, so we can get this done, because we need to start protecting and ensuring the economy from what it might do to itself. Also, 2020 is an election year, and without making this a political topic, which is something I do not want to do, but think about it. What does a strong stock market going into an election year mean for certain individuals? Just take that for what you will, and we're moving on. So that explains why the Feds cut the rate, but how and what does it mean to you or for me? They want to ensure and protect the economy that they thought was a little bit stronger than it actually is. So what does this mean for everyday turds like you and I? Are we screwed? Simply put, no. And simply put, no, you really won't see much of a difference, not right now. Some of the big changes right off the bat is, number one, you are going to see a slightly lower interest rate return to you on your savings accounts. That's because the banks are paying less interest to spend money to each other. The whole point of lowering the rate is to get people out investing and spending rather than saving and turtle shelling. So interest rates on savings accounts will be the first things that will be knocked down a little bit. But if you have a CD or a money market account, you're good. A CD, the rate is locked in, and a money market account, your rate is variable based on the return in the market. So things like money market accounts, your Acorns investing account is great. Actually, that's something you can do right now if you haven't already started messing around with Acorns. Is if you have a savings account and that's your primary financial move, which, you know, you see a lot of people like, oh, you're wasting your time not maximizing this and this and this by investing. If you're just somebody who likes to keep a savings account, because cash is a position, cash is the king of assets, so you're not wrong here. But if you're large in a savings account, you wanted to move some of it into something like Acorns or one of those services to where you are actually making a return based on the stock market, that probably wouldn't be a bad thing to do. Even right now, with as volatile as it is, there's an equal amount of positivity that's going on in the markets to where we're having these big upswings that come right after these, because a lot of people are viewing this trade war and the effects on the stock market as really good buying opportunities. You know, Warren Buffett said it himself. One of his biggest principles on investing is a bad day on the stock market is bad for some people, but for other people, you have a chance to buy that stock you wanted for a while on sale. That's a good way to look at this. So if you have a savings account where you have a lot of money tied up and the interest rates are going to be getting docked, maybe think about moving into something that it's a savings account with the ease of access, the in and out, the liquidity of the cash, but you also have the ability to reap the benefits of the market, and Acorns is perfect for that. You can check that out. I'm going to do a video on Acorns in the next coming weeks. I've used it for a long time, and it's a great little package software. Number two, for the good parts, variable rate loans. The interest rate on these will drop. Right now, we're only talking, the Fed only lowered the rate 0.25% of interest. So, you know, on your mortgage, you're not going to go from 4.59 down to 2% overnight. But over time, you will see a slightly smaller interest rate that's going to save you some money on your mortgage. Also on new mortgages, new auto loans, new personal loans, and extending to credit cards. Some credit cards, you will see a decrease in the interest rate. So there's going to be a big opportunity for saving some money there. That's huge. That's the biggest benefit of all of this. And if you think about what we said the purpose of a rate cut is, I mean, this is right in line, and this is where it happens. By lowering interest rates, you're giving incentive to businesses, everyday people like you and I, to go invest, to spend. And that's what they're looking for. They're looking for that. So the bottom line is this. The Fed uses its target federal interest rate as a tool to push towards the max, safest, most sustainable level of growth. And the balance for all of this, you know, coming together and us being able to achieve the max level of growth is the inflation rate. Lowered rates for too long and too much spending leads directly to a massive hike in inflation, and that's something that really whipped the economy back in the 80s, where inflation was up in the double digits. Right now, the Federal Reserve is struggling to hit their 2% target. We've been stuck about 1.5% for almost the last 10 years. Really, since we got involved and came out of that recession, consumer confidence hasn't really been that high. There hasn't been much spending. And we're also recovering from unemployment issues that contributes to that as well. So inflation is low, and they're looking to just really kind of push that barrier a little bit more to spark some new economic growth and to encourage some real consumer spending. Too high of an inflation rate, the economy gets SARS, money is worth less, and everything is much more expensive. Too low of an inflation rate, the economy isn't growing like it should be, yeah, that's it for that. So really, I wouldn't lose any sleep over it. Stay tuned to the news because I'm almost positive there are more rate cuts coming in September when they hold their next meeting. Or there is talks right now about an emergency meeting where they're going to go and be like, look, we did lower them, but we need to lower them more, so we're knocking off 50 basis points because they're looking for a big jump to try to offset some of the weird, random stuff that's going on in the economy, like this trade war, the upcoming election year, and all the other noise and jazz that's going on out there. This is my take on it. I'm not a professional economist, but I do study it, and I do try. And I do it for you, because god damn it, Steve cares. Thanks for watching. Hit that subscribe button, the like button, all of the buttons down below. Dislike it if you'd like. That would be nice. Leave a comment. Say something nice. Say something mean. And if you say something mean, hit that subscribe button so you can come back next week and say something mean again. I'd really appreciate that. Follow me on my social medias if you have any ideas for a future video or something you'd like to say. If you'd like to buy pictures of my feet, find me on social media, on Facebook. That's probably the best. Instagram. I do have a Twitter. I just started. Still trying to figure out how to tweet in Twitterland. And yeah, just let me know how you're feeling, what you're thinking. Thank you for supporting this channel. We'll come back at you in the next couple days with another video. Stay tuned.